Ladies and gentlemen, good day and welcome to the GNG Electronic Limited's Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Ms. Sauli Mange from Adfactors IR. Thank you, and over to you, Ms. Sauli.
Thank you, Rutuja. Good evening, everyone, and welcome to the Q2 and H1 FY26 earnings call of GNG Electronics Limited. Today, we have with us Mr. Sharat Khandelwal, Founder and Managing Director, Mr. Ajay Pancholi, Director, Mr. Rakesh Jhunjhunwala, Chief Financial Officer, and the Adfactors team. We will begin the call with an opening remarks from the management, after which we will open the forum for an interactive Q&A session. Must remind you that this conference call may include forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. The statements are not guarantee of future performance and involve risks and uncertainties that are difficult to predict. Having said that, I now hand over to Mr. Sharat Khandelwal, Founder and Managing Director of GNG Electronics, for his opening remarks. Thank you, and over to you, sir.
Good evening. Good evening, everyone, and welcome to GNG Electronics Q2 FY26 earnings call. It's a pleasure to be speaking with all of you today, our shareholders, partners, and colleagues, at a time when both our company and our industry are undergoing profound transformation. Over the past few quarters, we have seen GNG evolve from being a fast-growing refurbisher to become a technology enabler, powering a more intelligent, sustainable, and inclusive digital world. This quarter is particularly significant. It marks our first full reporting period as a listed company. I want to begin by expressing my gratitude to our investors for their confidence, to our customers for their trust, and to our colleagues across geographies for their relentless drive. Our journey is built on a simple but powerful belief that access to cutting-edge technology shouldn't be limited by cost or constrained by availability. We are living through a remarkable moment in computing history. Artificial intelligence is no longer a distant future. It is here, reshaping how people learn, create, and work. But as demand for smarter, faster, AI-enabled system surges, the world is also confronting new challenges: chip shortages, sustainability imperatives, and widening digital divides. GNG's global business model, built around refurbishment, renewal, and circular efficiency, stands right at the intersection of these forces. We are enabling access to intelligence, not just devices, progress, not just performance. As I often say, at GNG, we don't just measure growth in numbers, but in the impact we create. Every refurbished system we deliver means more people empowered, more resources conserved, and more innovation made possible. Over the next few minutes, we'll walk you through how we have delivered another strong quarter of growth, expanded margins, and continue to build resilience into our business model. You'll also hear how we are positioning GNG Electronics to lead the new chapter of the AI-driven computing cycle responsibly, inclusively, and profitably, and how we have been able to build our brand equity of Electronics Bazaar in India and around the world, including developed economies. Let's start with AI. At GNG, we believe the next wave of growth will be shaped by how technology moves closer to the user, not just in the cloud, but on every desk in every enterprise. Our laptops and computing devices are becoming the access point of intelligence, powered by edge AI, sustainable design, and seamless connectivity. Now, for 50 years, technology was all about calculating and computing. But now we are evolving into machines that help us think and are thinking for us. And what are these models creating? They are creating intelligence. As AI continues to expand into business and governments around the world, the opportunity ahead for us is massive. As case in point, AI is now driving nearly 45% of US GDP growth, and analysts project that by 2030, AI will add over 15 trillion to the global economy, pushing global GDP towards 150 trillion. Customers are hungry to understand AI, and they need to deploy intelligence at scale at very affordable prices, offering immense opportunity for us. Our strength lies in how we operate. Through efficient global sourcing of high-end systems and a deeply engineered refurbishment process that restores these devices to enterprise-grade performance. By refurbishing laptops to precise quality standards, we enable individuals, startups, institutions, and enterprises to access AI-ready systems at a fraction of original cost with 1 to 3 years of proven credible warranty without compromising reliability and performance. In a global economy moving towards intelligent, sustainable technology, GNG stands at a unique intersection where AI capability meets circular efficiency. We are transforming how technology is sourced, renewed, and delivered, turning what was once excess and unusable asset into a catalyst for progress. Our purpose is clear: to make AI-enabled computing attainable for all, while building a future that values innovation, access, and responsibility in equal measure. As artificial intelligence reshapes the global technology landscape, it is triggering one of the largest surges in computing demand the world has ever seen. The early stages of AI adoption are just the beginning, and the models we see today, while impressive, represent just the foundation, with each wave of innovation taking us further. In this new era, the laptop has evolved from being a personal productivity device to becoming the primary interface through which millions of professionals, students, and creators engage with intelligent systems. The shift has transformed computing from a utility into an enabler of imagination, collaboration, and productivity, redefining how people learn, create, and work. EV is the core enabler of the next global technology cycle driven by AI, and at GNG Electronics, we see AI as a value multiplier, not just an automation tool, but a catalyst for redesigning core business processes. Our next generation laptops are built to empower this transformation, enabling businesses to unlock AI-driven insights, streamline workflows, and elevate productivity across every function. The demand for high-performance AI-ready laptops is accelerating rapidly across sectors. As the computing world shifts from a cloud-only model to a world of AI everywhere, laptops are emerging as the foundation of this intelligent revolution. Personal, portable, and powerful. They are no longer just devices, they are the engines of AI productivity. However, this explosion in adoption coincides with an equally critical challenge. The world is entering a period of supply constraints, global semiconductor shortages, power bottlenecks in data centers, and a heavy concentration of chip manufacturing capacity have all begun to strain the availability of new devices. Bain's 2025 analysis warns of an impending AI chip crunch as hyperscalers, governments, and enterprises compete for same finite pool of advanced processors. In such an environment where demand is soaring and supply is tightening, GNG Electronics finds itself in a uniquely advantageous position. Our business model, centered around the refurbishment and reconfiguration of high-end laptops, offers an agile and sustainable solution to this market imbalance. By sourcing, renewing, and upgrading premium laptops, GNG can deliver enterprise-grade performance without depending on new chip production cycles. Refurbished laptops optimized for AI workloads and enhanced memory, storage, and GPU capabilities can meet the needs of modern users at a fraction of cost and time required for new manufacturing. This approach not only addresses the immediate supply constraints, but also aligns with global priorities around sustainability and the circular economy. As industries and governments alike focus on responsible consumption and reducing e-waste, GNG stands at the intersection of innovation and necessity. By providing AI-ready refurbished laptops, the company ensures that the benefits of artificial intelligence remain accessible, affordable, and sustainable, even as the global tech ecosystem grapples with supply-side challenges. While traditional OEMs struggle with constrained supply chains, GNG Electronics bridges the gap between global demand and responsive production. From the AI PC that you can hold in your hand to enterprise scale deployments, the world is going to need a whole lot more compute, storage, and networking, which is exactly where GNG can contribute. AI is driving an era of intelligent computing, and GNG Electronics is ensuring that access to this intelligence remains open and inclusive, powering the AI revolution, one refurbished laptop at a time. As AI adoption continues to accelerate across businesses, education, and creative industries, GNG Electronics is poised to become a critical enabler of this transformation. Its expertise in delivering premium, performance-optimized laptops will allow organizations to scale their AI ambitions without being constrained by hardware shortages. Through this, GNG is not merely responding to technological change, it is helping define a new responsible model for growth in the AI economy, one where intelligence and sustainability power progress together. Now I would like to talk about our brand, Electronics Bazaar. Over the last few years, GNG Electronics Limited has embarked on a focused journey to build Electronics Bazaar into a global brand-led enterprise. This evolution reflects the company's growing maturity, self-sufficiency, and commitment to long-term value creation through a unified identity. As we have expanded internationally, we have consciously strengthened our brand ecosystem, integrating procurement, refurbishment, quality control, and after-sales service under a single framework. By consolidating these core functions, we ensure higher process efficiency, consistent quality, and full ownership across the value chain, marking a significant milestone in our journey towards becoming a globally recognized leader in sustainable technology solutions. Our proprietary brand, Electronics Bazaar, enjoys strong credibility, brand pull, and global demand across multiple markets, that is, in more than 40 countries. Given our proven operational capabilities and growing customer trust, channelizing resources toward our own brand, synonymous with reliability, credibility, and value, is a natural progression. Refurbished ICT devices, which are standardized and like new looks, performance, and credible warranty, is a global category creation pioneered by us. Through this evolution, Electronic Bazaar has assumed a central role in customer engagement. Leading with our own brand identity allows us to capture more value internally, improve margins, and delivers a seamless, consistent experience to customers globally. This ensures superior efficiency, faster turnaround, streamlined workflows, and complete process control, and empowering our teams with full ownership of quality and output. With a proven in-house system managing refurbishment and service quality, Electronic Bazaar embodies world-class standards. Guided by our long-tail to long-tail philosophy, which diversifies both supply and demand, expanding our proprietary brand reach enhances business resilience, scalability, and profitability. Today, Electronic Bazaar stands as a trusted global brand in the refurbished ICT sector, combining quality, efficiency, and sustainability. Through our fully integrated value chain, spanning procurement, refurbishment, and distribution, we deliver consistent value at every stage. Guided by our principle of buy better, refurbish better, sell better, our scalable multi-country business model serves primarily B2B customers and resellers by offering consistent and reliable product supply, like new, functional, and aesthetic quality, comprehensive replacement warranties. With sales diversified across 40 countries, we are well planned from region-specific risks. Our strong independent sales and distribution network minimizes dependency on any single partner or customer, ensuring direct engagement, stable margins, and sustained long-term value creation. Electronic Bazaar is now a symbol of operational excellence, sustainability, and leadership in the global circular technology economy. I will now hand over to our CFO Rakesh, who will take you through half-yearly performance of the company. Thank you very much.
Hi, good evening, everyone. Happy to share our half-yearly results. GNG Electronics has delivered another quarter of strong performance, reinforcing its leadership in the high-end refurbished ICT device segment and sustaining its growth momentum through the first half of FY2026. During the quarter, revenue has grown to 4,399 million rupees, marking a 41% sequential increase over Q1 FY26 and a 25% rise YOY, driven by higher throughput, strong institutional demand, and continued expansion across both domestic and international markets, particularly the Middle East and the US. For the first half of FY26, consolidated revenue has reached 7,422 million rupees, representing approximately 24% YOY growth, reflecting the company's ability to scale consistently across geographies and customer segments. Gross margin for Q2 FY26 stood at 19.9% compared with 14.5% in Q2 FY25, reflecting 37% YOY margin growth, while H1 gross margin averaged 20.5% versus 16.9% in H1 FY25, scoring significant margin expansion. EBITDA for Q2 rose to 467.81 million rupees, translating into a margin of 10.63% versus 10.17% in Q2 FY25, while H1 EBITDA stood at rupees 819 million with a margin of 10.9% versus 10.4% in Q2 FY25, highlighting strong operating leverage and structural cost efficiency. Profit after tax for Q2 FY26 stood at rupees 326 million with a PAT margin of 7.4%, up from rupees 230 million, which was 6.5% in Q2 FY25, reflecting 42% YOY growth in PAT. For the half year, PAT totaled to rupees 512 million, translating into a 6.8% margin against rupees 352 million, reflecting 45% YOY growth, demonstrating steady profitability and strong earnings. Together, Q2 and H1 performance reflecting GNG consistent execution. The company continues to benefit from its asset-light model, positioning it well for sustained growth and profitability in the second half of the year.
Shall we start with the question and answer session?
Yes, sure.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hiten Boreja from Sequent Investments. Please go ahead.
Yeah. Thanks for the opportunity, sir. Good evening. So my first question is on the inventory. So want to understand what's the total percentage of inventory which is aged beyond 1 year to understand the sellability of the products as the inventory gets older.
Yeah, hi. So to answer your question, we have no inventory which is more than 1 year old, so that essentially answers that there's no old running stock that we carry on our books. So as we've emphasized over the period of last couple of quarters or last quarter as well as this, we continue to have a robust monitoring of inventory in terms of what we buy and what we sell. So the focus is to buy products that have a good turnaround time in terms of market acceptability. And that's clearly what we've been able to achieve over the years. And that's also reflective of the fact that we've had no history of inventory write-offs.
Okay. And so also if you can throw some comments on receivable, which has increased from 67 odd crores to 175 crores this year.
Yeah. As you would imagine, our business is a working capital intensive business. We compete with brands as well, or the companies that sell new products as well. And the requirement of this business is that we need to support our channel with credit. So the typical credit period that we offer is pretty much in line with what is offered by typical businesses, and which is in the range of somewhere between 30 to 35 odd days. And we see receivables on similar lines. And again, I would like to emphasize on the same breadth, the way we have full control over our inventory, we are also very mindful and meticulous in terms of to whom we sell. This is also demonstrated by the fact that, again, we've had no history of any bad debts. Receivables are well managed, and we necessarily need to support our channels in terms of enhancing our product acceptability in newer markets, newer geographies. And at the same point of time, we have been able to consistently maintain our receivables without any hiccups in terms of any write-offs or anything of that nature.
Okay. So my second question is on the warranty side. So we provide warranty on our products. So if you can share the total warranty liability which is reflected in our balance sheet.
So I would like to highlight that our warranty, it's a 3-year warranty for all products that we sell in India. And for our global sales, the sales that happens out of India, the warranty is a 1-year period. Now, it's important to highlight that while we have started offering a 3-year warranty almost a year back, and also important to, and why did we offer the 3-year warranty on the domestic side as well, is to ensure that we have a good acceptability of our product in the market. We have had a good trajectory in terms of our product quality and output, and that is demonstrated by the fact that we enhanced our warranty from 1 year to 3 years, primarily because we really saw that the products were working well accepted, and also from a history perspective, the warranty incidence that was coming in was about 2.1% of our sales. That having said, given that we have not outsourced warranty as a proposition to any of third party, our cost of servicing this warranty is extremely low in the 10 to 12 odd basis points, and hence we are currently taking it entirely to our P&L. We do not see incremental warranty costs also as we keep on scaling up. We expect it to be in similar lines in terms of the cost, so hence we are not taking it. We have not had a provisioning mechanism for now, but maybe in the longer run we'll think of instituting that in due course.
Understood. So my last question is on the finance cost. So our debt has come down from. Hello, am I audible?
Yes, you are. Maybe if you could come back in the queue, that would be appropriate. 2 questions at a time, please, if you don't mind.
Okay. I'll be back in the queue. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer questions from all participants, we request you to please limit your questions to 3 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Abhimeva Wala from Okain Capital. Please go ahead.
Hello, am I audible? Hello.
Yes, sir, you are.
Yes, you are audible.
Okay. So you mentioned that around 220 crores of debt in last Concall you paid, and around 100 crores you will be paid in few days. So still there are around 205 CR on balance sheet. So what is the reason behind this?
Sorry, could you repeat your question?
So basically, in last Concall you said that around 220 CR of India debt you already paid, and in few days you said that around 100 CR of UAE debt you will be paid. But still on balance sheet there is a 205 CR of debt.
Okay, so let me address that. So let me give you an overall perspective of what the debt situation is in terms of net debt as on. So as on 31st March, our gross debt was about 447 odd crores and net debt of about 390 odd crores. What has happened in the quarter, in the last quarter is, yes, we have consummated our IPO. The net debt position as of 30th September is a total of 158 crores. This duly factors in all the repayments that we had envisaged by way of the IPO, which is 220 odd crores of working capital debt repayment in India, as well as the incremental debt that we had from in the UAE subsidiary as well. So those repayments have also happened. In addition, the debt currently is at 150, as I mentioned, the net debt is at about 158 crores. That's purely working capital debt that is continuing on the books. So the use of proceeds have been addressed towards the objective that the funds had been raised.
Okay. And sir, any additional fund is required for future growth, or this fund is sufficient for 2 to 3 years growth?
Yeah. So as we see, the current equity base is pretty much robust and will take care of our future growth. And as the equity base also provides us with reasonable headroom for any opportunities that come our way going forward. So we do not see the need for any incremental equity raise in the near to medium term future. That having said, the headroom that will be available as opportunities keep on coming our way will be sufficient for us to address in an opportune manner take those opportunities with the headroom that's available from the debt headroom.
Okay. And the last question, I want to know about competition in the market. Are there any competition in terms of better pricing to suppliers, that suppliers shifting to other players? Anything like that?
This is Sharad here. Can you repeat your question, please?
So I am asking that is there any competition in the market, like peers give better pricing to your suppliers like that, and they are shifting to other players?
No, not that way. See, number one, we are international. We are now selling in 42 countries. We are selling in Europe, around 18 odd countries. We are selling in Middle East, and we are selling in the US as well as obviously in India. So the competitions are what we face are regional, but what we are doing equal to new kind of product with performance and very credible warranty and responsive warranty is making us stand out separately. Our proposition, which is more like a service than a product, is gaining more acceptance day by day, and which will have obviously a positive impact on profitability as we move along. This business is very, very supply chain oriented. We have global supply chain, and we can procure product in one territory and sell in another territory. These advantages at this point of time, no one in the world is having. So we are not encountering any competition as such, but yes, there are regional competition. More and more people are accepting refurbished products now by Electronic Bazaar. That proposition is gaining acceptance more so with warranty, with equal performance. The product goes in unique packaging. The product gets its due respect. And more and more people who are heretofore selling brand new product, whether it is in Miami or Frankfurt or in Middle East or India, are selling refurbished product refurbished by us. Even the big distributors, in due course of time will update you, are now aligning with us so that they want to sell our product. It is not easy to buy refurbished product from anyone. It is not easy to sell refurbished product of anyone.
Okay, thank you.
Thank you. The next question is from the line of Paras Chera from Purple One Vortex Ventures. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations for a strong set of results. I have two queries, sir. You had mentioned, Nathan, that
I'm sorry to interrupt you, Mr. Chera, but your voice is not sounding clear. It is very muffled. Can you please check?
Okay, yeah. Is it audible now?
Yes, please go ahead.
Yeah, sir, you had last time on the last Concall mentioned that the impact of the US tariffs is probably not going to be there on our company, and we are, in a better place. do you continue to, still feel that that's, going forward, there is not going to be any impact on the tariffs front? That's number one. And secondly, do you have any guidance? I presume that the guidance for this year, FY26, probably of northwards of 20% is probably holding for now. Do you have any updated guidance for FY27 as of now? So these are the two questions for now.
Yeah, thank you. Thank you, Paras. Nice to hear you back again. With respect to US tariffs, the impact is still not there and we don't anticipate it to come. There are a number of reasons for that. As I mentioned, that 8471 HSN, which relates to computer, which we primarily deal in, does not attract any custom tariff in America, including the baseline tariff of 10%. Only except when the product is China produced, there also recently the duty has come down from 20% to 10%. But that doesn't also impact us because we procure products from the US, refurbish and sell back to the US market. So our tariff impact is only on the value addition part, which is $15. So 10% on that is very, very minuscule number. Number 4 is because the tariff impact both brand new and refurbished equally, the delta of both the delta gap remains. And this number 5, the UAE facility and the India facility that brings the cost and skill set advantage, they are simply not there in the developed economies. So our proposition remains there and we have not impacted by US tariff at all and we don't anticipate that to in the near future. With respect to guidance, the guidance that we gave in our previous call, 20-25% top line growth and 75 bps margin improvement, that still holds because we want to lean on the side of caution. With respect to 26-27, let's wait for the next earning call. Maybe we'll be better placed. And idea is to remain more conservative. But I can tell you one thing is that it is possible and we are endeavoring in that direction. The credible warranty, the quality and credibility that we have been able to offer and which is finding a lot of acceptance will be able to drive margins for us.
Okay. Understood. Fair enough, sir. Yeah. Okay. Thank you.
Thank you. The next question is from the line of Kunal Mehta from Sunidhi Securities and Finance. Please go ahead.
Hi, very good evening, sir, and congrats on the good set of numbers. So my question is that in this quarter or even in this half-year result, we saw 24%, 25% growth YOY. Our gross profit grew about 71% on a consolidated level, but the EBITDA just grew 41%. So even though our gross margins improved by about 500 bps, our EBITDA did not see major improvement. Can you highlight why the gross margins grew this much and why the EBITDA did not grow and what are the peak EBITDA levels that we can expect going ahead?
So in terms of EBITDA margin guidance, we've been able to enhance our gross margins on account of our ability to procure better and sell better, right? That having said, in terms of trajectory, where do we expect the EBITDA margins to span? Last year, you would have seen our EBITDA margins were in the, I think, about 9% ballpark range. Now, that was for the full year. This year we are expecting it to, you've seen the number this year itself, the gross margin, the EBITDA margins are north of 10% plus. We anticipate to keep on enhancing our margins by, as Sharadji mentioned, by about 75 basis points. And this will get reflected as we continue to grow and the product is more acceptable in the market. Also importantly, it's worth highlighting in terms of the margins is we've in this last quarter and the first half, there's been a lot of investments that we have put in place in terms of talent and people. That's what so we are really gearing up in terms of to take up the opportunity, and that's what, as if you look at our employee cost, that's really come up a bit, and that's really reflective of the fact that we've added talent. We have scaled up from about 1,100 odd people last year, 1,134 in the same time last year to about 1,500 odd people. Also important to highlight that the sales and marketing function, which is one of the core aspect, that it has also been enhanced from about 90 odd members to go to about 150 plus. So despite these temporary increases, the cost discipline remains evident, and the expense ratios are around range about. Operating leverage will kick in, and that's really how we see the EBITDA margin and the operating margins kicking up as we move forward.
So the other expenses has almost like grown by 176% quarter like YOY. So what are the extra? I mean, is it the warranty expense that has been in the P&L? What are the other major expense line items and other expenses?
So in other expenses, the major line items pertain to I would say the logistics cost, marketing, and travel and marketing and hiring costs and so on and so forth. So if you really look at the key costs, as I mentioned, just to emphasize, there's a lot of investments that we have done. So which is also a lot of the travel, the marketing, etc., which we have hired people across in the Middle East and in the US as well as in India. That's really is reflective of the other costs also moving up. And we definitely see these investments to really give us the fruits as we go in and bite on the opportunities as they come out.
Okay, so my second question is, so I think in the opening comments I spoke about AI automation. So what kind of automation are we bringing in our capacity lines or the refurbishment lines? And how much is the total capacity, right, if you can mention that as well, for refurbishment?
See, AI, I mentioned as the AI is changing the world as we see it today, because AI is coming in every walk of life, and that AI comment I have reserved for my closing comment also. What I meant by AI is that we are making products ready for use as enterprise grade AI to be used. AI is really changing the world we live in. It is changing how we study, how we work, and how we do our business. And similarly, that is increasing the demand for high-end computers. For us, that's a massive opportunity because it leads us to enterprise-grade hardware, the server, workstation, the comments I have reserved for my closing remarks, and I will touch upon at that point of time. We are seeing more and more demand for high-end computing. And we are seeing more and more demand for the high-end computers with high-end processors and high-end memory and high-end SSDs. So that is changing, and that kind of product, affordable and credible, both as a refurbished product, is really putting us in a very, very strong position and very advantageous position. In terms of our capacity, we are doing capacity. Since we are now requiring more space because of enterprise-grade computers and servers and all this, we are taking more space. The comment that I'll again take it towards the end. But at this point of time, our current capacity globally is north of 120,000 units a month.
Okay, sir. Yeah, I'll jump back in the queue for more questions.
Thank you. Participants are requested to please limit your question to one per participant. The next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah, thanks for this opportunity and congrats for the results. Sir, first question is, if I see your results last year, second half, our margin came off. EBITDA margin declined from 10.4 to 7.8. So is there in the last quarter you might have to incur higher expenses and the margin come off? Basically, the margin decline in the fourth quarter was higher as compared to other quarter. Hello.
So the EBITDA margins are higher only in the last quarter as well. In the second half of last year, that's what you're referring to, right?
Yeah, second quarter.
So in the first 6 months of current financial year, our EBITDA margins are 10.9%, and corresponding half year ended September 24th is at about 10.4%. So there's a 60 basis points EBITDA margin improvement.
Okay, I'll take back the question. My calculation was indicating that you got 7.8% margin in second half of the last year. Sorry, I'll take that offline. Are you sharing volume figure also in this quarter?
Yes, we'll share the volume numbers as well. So broadly, you want to know the volume numbers now? I'm happy to take you through that. Yeah, sure. So the volumes that we have achieved in the first half is about 302,000 odd units in total. Also important to highlight that in terms of breakup of revenue between laptops and other devices, it's about 80-20 odd in terms of value terms. This was at in corresponding half year in late 24. This was at 75% and 25 odd percent. Also importantly, in terms of number of units perspective, laptops has been at 72% as against 28% for others. So there's a better realization that's demonstrative of the revenue numbers from laptops. So that's broadly in terms of the laptops and others. As Sharadji mentioned, it's important. I would just want to draw your attention. From a capacity perspective, 120,000 units a month. So you can do the math. First half we have done about 3 lakh units. So from an opportunity perspective, you can envisage as to which direction we are heading.
Great, sir. And any expansion plan you can talk about?
I think Sharadji mentioned that already, right? So we'll continue our growth journey as capacity. I think it's reflective of the fact that with what capacities we can cater to and what we are veering towards. And this would definitely entail, and the investments that we have done in terms of people, sales and marketing, incremental space arrangements in various geographies, etc., that we are researching, that will all add to capacity and capability enhancements.
Thank you very much.
Thank you. The next question is from the line of Chandesh Malpani from Niveshaay. Please go ahead.
Hello, am I audible?
Yes, Chandesh, go ahead.
So thank you for the opportunity, sir, and congratulations on a good set of numbers. So, sir, my first question is regarding the India versus the outside sales. Can you give the bifurcation between that?
Yeah, sure. So in India, we had a revenue of about 296 odd crores in the first half. So almost about 300, and as against a total of 752 odd.
Okay, got it. And sir, one more want to understand from you is that the refurbishment versus the new.
Let me mention that India contributed 39.47% of revenue, Middle East 32.24%, other including Europe is 13.79%, primarily Europe, and the US constitutes around 14.51% of our revenue. Yeah, you were asking something.
Yeah, that was helpful. Thank you, sir. And so second question is on the one thing which we could understand is the refurbished laptops available at let's say 1/3 of the new laptop cost. So in this current scenarios where tariff and rare earth thing is also happening, so are we seeing that arbitrage going more towards the refurbishment laptops, and so the volume should pick up? Are you seeing any signs of that?
Yeah, so refurbished as a value proposition is becoming stronger by the day. And tariff and all these situations made the proposition even more stronger because people require high-end computers for AI and other uses, companies and individuals alike. At one-third of the prices, more and more acceptability is happening. More and more people are open to using refurbished devices, and more people are open to selling their existing assets when they get comfort around pricing and the privacy, when somebody offers them good price. And offering good price is a function how you refurbish and how you sell. So you are right. The tariff and other uncertainties, they lead to people reducing their capex, and hence the overall refurbished as a segment is growing. As a tariff related also, but even otherwise, tariff or no tariff, refurbished product, refurbished computer devices will obviously increase their share within overall computing. And high-end computing means more refurbished at affordable prices, and we would like to be very prominent and very strong globally to take advantage of this impending demand surge.
Okay, and sir, one last question, like you mentioned about the data days, about 30 to 35, which is as per the industry standard. But like, can you help me understand basically the mix of our sales, where we are, directly selling to B2B corporates, and we are also certified refurbisher for two of the largest brands. So, like, what ideal mix are you targeting in terms of having the better return ratios here on?
See, 30 to 45 days of debtor days is a reality in the computer business, because what we are competing with, not with much with refurbished sellers, we are competing with the brand new sellers. So at that point of time, to make the proposition relevant and affordable and attractive, we have to offer similar credit terms to our customers. And our customers are either business customers or people who sell to businesses. So we can't be uncompetitive in any way when we approach them. So I think the debtor days will remain within this range in the foreseeable future.
Okay, and so just one last question, like this quarter, we didn't saw the entire, like the positive impact of the debt saving, right? And we can further expect this interest cost to go down.
Yeah. So as you rightly observed, that we essentially got access to the equity raise only towards the beginning of the month of August, and part of it we immediately repaid at the beginning of August, and part of it towards a month or 45 days later once we got the RBI approvals for the remittance of fund. So you're right. So to that extent, we've not got the significant part of the interest cost savings that would have one would have envisaged. So as you rightly, I'll just repeat. I'm not too sure where I dropped. As you rightly observed, that we've not had the benefit of the equity money for a significant or the most significant part of the last first half. So at best, we would have had the benefit of maybe a month or so of interest cost saving. So we are likely to see the saving of interest cost on account of the funds being available. So we are anticipating somewhere around, I would say about 10-12 odd crores of savings in the second half on an entire basis. So you should factor in that. I'm giving a ballpark range. As I said, that we will continue to focus on opportunities. The need for working capital is what the business will significantly be driven on. And that having said, discipline is the key, whether it's in terms of inventory or data, and that's what we continue to focus and maintain. Interest cost savings will definitely help us enhance our bottom line in the second half.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. Participants are requested to please limit your questions to one per participant. The next question is from the line of Asta from KD Advisors. Please go ahead.
Hello. Thank you for the opportunity, sir. So my first question is around the official partners that are the HP and Lenovo in India. So does that mean that whenever these brands run an exchange program, then the used laptops come to us, or are we the only partners with them? And are these guys also are we also partner with Dell and other brands?
See, with respect to brand partnership, they are more like a credential to us. they do not reflect dependence on them for our business. We are independent in our sourcing and independent on our sales. The buybacks and all that we run in conjunction with brands as well as separately. And all the product that we sell, warranty is serviced by us. With respect to, so 97% of revenue is now directly contributed by Electronic Bazaar as a brand, right? And 100% of revenue is backed by Electronic Bazaar's comprehensive warranty cover, reinforcing our customer trust and brand reliability. We can sell all the brands, Dell, HP, Lenovo, Apple, because there is a right to repair framework, or there is a right to repair act, and there is a global push towards sustainability and climate agenda. More so the cost saving and all these things, they make the proposition even more relevant.
Got it. But it's not so, since you said there is a more push to sustainability, I want to understand that do we have official partnership with large enterprises as their electronic disposal partners?
Yes, we have. We work with large enterprises in India as well as the global markets, and we take back their assets, refurbish them, and sell them. So we deal with one of the largest leasing company in India, second largest software company in India. We deal with the consulting companies in India. We deal with leasing companies around the world in the US, Europe. We also deal with US Justice Department for disposition. We deal with the biggest ITACs, Iron Mountain in the US. We buy from them and we refurbish and sell also to them. Different products, not the same, obviously. So we have tie-ups with them, and this continues to grow through our US office, where we are increasing our presence. We have good set of talent now there, and the presence goes on. So we are tying up with more and more corporates because we are able to offer them better price, and we are able to meet their sustainability and privacy goals. So COP28, the climate operating plan, also mandates, it gives a good push towards refurbishment. Reuse is the best form of recycling. So refurbishment is a central piece. So that also gives a good push. And that's why the companies are also realizing that for the climate, they have to dispose of assets responsibly, and they are able to realize value through us. So obviously, when they sell it to recyclers and that, they don't get much. But when they sell to us, where we made the sustainability and privacy goals also, and offer them fair price, so it's a win-win for them, win-win for everyone.
Sorry to interrupt. May we request Asta to please rejoin the queue? We have participants waiting for their turn.
Sure, thank you.
Thank you. The next question is from the line of Ankur Gulati from Genuity Capital. Please go ahead.
Sir, is there a seasonality in our business where second half is higher revenue or anything of that sort?
Yeah, of course. The second half is, as we've mentioned, and we continue to maintain, the second half is always better than the first half on account of various things, year-end closing, fiscal closing, calendar closing in India as well as globally as well. So definitely the second half is way superior in terms of revenue and projection going forward. Yeah.
In the last 3 years, what is on average H2, H1 ratio of revenues?
Yeah, sure. So just to highlight, we've mentioned this in our last con call as well. Broadly, the first half constitutes to about 40-43% odd in terms of the proportion, and we anticipate this to remain somewhere in a similar trajectory, ballpark. And it's directionally the same year over year.
And the last thing on the recycling or refurbishment, is there any EPR benefit going to us?
Yeah, we are still evaluating that. We've not factored any of those the potential EPR benefits coming into our P&L, but that's incremental work that we need to do to take the benefit of the same.
But based on your understanding, you're eligible for it if you file for it, right?
Yes. Yes.
Okay, thank you.
Can the Chorus Call team just add Sharadji is dropped off?
Surely, just give me a moment. So, shall we go ahead with the next question?
Yes. Yes, please go ahead.
Thank you very much. The next question is from the line of Parikshit Kabra from KD Advisors LLP. Please go ahead.
Hi. Thank you for the opportunity. My first question is on the current assets. They have risen drastically this quarter by almost 60 crores. What is the reason for that? Other current assets. Hello?
So other current assets. Yeah. Can you hear me?
Yes.
Yes. So other current assets basically include advance to vendor, and a significant part of that, almost 100 crores odd, is towards the advance to vendors. As we see larger opportunities of purchases, and typical of our business, we have to pay the money in advance, and we thereafter collect the product from various facilities of the vendors, and the balance part of it, as against 100 and what's the number, 120? Yeah, so about 17 odd crores is the GST part of it, but broadly it's advance to vendor.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to the management for closing comments.
Yeah, thank you. I'll just add one more operating matrix out over here, which I missed earlier in terms of unit dynamics. So the ASPs that we have been able to achieve in the first half is, as anticipated, better than corresponding first half. Our ASPs on laptops has increased from about 25,800 odd rupees to about 26,800 odd rupees in India, and internationally also it's improved from about 27,500 to 28,500. Similar thing applies on our non-laptop versions as well, which is again an enhancement of on an average about 2 to 3 odd % on an overall basis. On that note, I'll request Sharadji to address with closing remarks.
Yeah, thank you, Ajay. I would like to make closing remarks. In conclusion, I would like to state that our customer touchpoints have increased from 4515 to 4515 from 14157, and we now supply to 42 countries, up from 38 earlier, including three new markets in Europe and South Africa. Our supplier base has grown to 601 from 557. Total employee strength has increased from 1194 to 1500, and our sales and marketing team has expanded from 96 to 157. Leadership hiring continues across functions and geographies to support our next phase of growth. Secondly, approximately 97% of our revenue is now directly contributed by Electronic Bazaar as a brand, and 100% of our revenue is backed by Electronic Bazaar's comprehensive warranty cover, reinforcing our customers' trust and brand reliability. As the computing landscape shifts towards AI-driven performance and data-intensive workloads, GNG Electronics is expanding its global operating base to capture the next wave of opportunity. This marks the beginning of our entry into infrastructure-level refurbishment, a natural progression from our leadership in laptop and ICT devices. It will enable us to deliver AI-ready computing systems, servers, storages, and high-end desktops at affordable and sustainable cost points for global enterprises. AI is not just a technology trend, it's a way of life, a way of business, and a way of learning. The rise of large language models, LLMs, demand affordable, customized, and premium refurbished computing systems. Refurbished laptops will play a crucial role in driving the global AI boom, enabling digital adoption at scale. Furthermore, with data privacy shaping the next frontier of innovation, we are entering the era of personal AI, a new class of AI system that process and learn locally on personal devices, as already highlighted by Qualcomm. In this evolution, devices and device ownership becomes even more critical, reinforcing the centrality of refurbished computing in the AI era. To achieve these strategic goals, the company has preemptively secured long-term spaces across India, Mumbai, primarily UAE and the United States, which will serve as high-capacity refurbishment and testing centers for advanced computing systems, including servers, data centers, hardware, and enterprise-grade IT infrastructure. This expansion aligns with our asset-light model, not requiring heavy capex, and positions GNG Electronics at the heart of world's emerging AI hardware ecosystem. By building ahead of the curve, GNG is not merely expanding its footprint, it's establishing the physical backbone of its evolution from a leading refurbisher to key enabler of the global AI hardware revolution. Thank you all for participating in the meeting.
Thank you. On behalf of GNG Electronics Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.